Adam Myers and I lead the distribution team at Pengana. Thank you for joining us for our first webinar in this series, an update with Rhett Kessler, the CIO of the Pengana Australian Equities Fund. The format for today's webinar is going to be slightly different. I've asked Rhett to keep his prepared remarks reasonably short, so we'll have plenty of time for questions at the end. Hopefully more of a discussion than a standard presentation. So please, any questions you have about the fund or the macroeconomic environment or anything else, preferably related to Australian equity investments, enter them into the Q&A box. You can access that from the icon on your screen, and hopefully within the constraints of a Zoom webinar, we will be able to have a really interesting conversation. So Rhett, over to you.
Good morning. So it's always interesting for me to be told to restrict the length of my presentation. I'll do my best. I'm going to go for about 15 minutes, essentially covering where we think we are in the cycle, the macro, and then how the portfolio is positioned and why we're in each of our big blocks of investments. We did contemplate changing the front page, but given that the current struggle between central banks and trying to remove liquidity, plus trying to bring inflation under control, we thought this picture of this raging rhinoceros really chasing investors is still very, very appropriate. If we just recap what we think investors' needs are, we obviously think it's capital preservation and a reasonable real return. The one big change to the portfolio, to the environment, is that the risk-free rate has been very close to zero for some time and has since lifted, currently at 2.6%, and we expect that will go a bit higher. Bear in mind that we're absolutely very risk aware, but remain completely benchmark agnostic. And we think our mandate is to preserve and grow the purchasing power of the funds entrusted to us. And the reason why we've added that phrase, even though it's consistent with everything else we've said, is because we've believed for some time that inflation is becoming a real challenge. So where are we in terms of macro? Well, there's no doubt that after predicting it, probably a bit too early, predicting it for 2 years, inflation has well and truly arrived. And remember that it's an unusual kind of inflation because it's a combination of both stimulus-induced demand being exaggerated, as well as widespread supply chain constraints, both through COVID plus the hostilities in Ukraine and Russia. Absolutely, the cheap money party is over. And remember that when interest rates went down to super low levels, every central bank said this is an emergency setting, and they're now lifting rates enormously. That's something that's particularly makes it particularly complicated is that many of us have never experienced, in fact, all of us have never experienced QE before, and to try and lift interest rates this fast, plus reverse quantitative easing, which is really just excess liquidity in the banking system, has enormous ramifications, particularly for long duration assets. We shouldn't forget that geopolitical risks remain elevated. Instability continues in Eastern Europe. In fact, went up a few notches overnight. And something that people are only starting to talk about now is that Chinese residential property development is very, very concerning. Essentially what happened there, lots of developers took deposits, actually didn't keep that money to build or develop the properties, but have spent it, and now having to raise additional money in very difficult conditions to try and complete the buildings. Obviously, US and China relations remain in the spotlight, and Taiwan might be, a difficult area in the future. Layer over that, and I know this sounds very, very negative, but layer over that, forecast risk also remains high. We've had 3 years of very unusual trading, mainly due to COVID, and then all kinds of supply chain disruptions. So trying to understand what is a normal year for any of the companies we cover is very difficult, and so forecast risk is quite high. Now, we've been predicting many of these things. Valuations have rebased enormously, and we think they're still rebasing, and we're finding opportunities to deploy cash. The overriding theme that I've brought up over the last 2 years is this thesis that, and it's turning into practicality, is that over 30 years, we've had ever declining interest rates. And what I'm showing you here is the US 10-year Treasury yields going back almost 300 years. And you can see that we've lived through quite an unusual period of super high interest rates in the early 80s, coming all the way down to zero due to a combination of various issues, including globalization, COVID, etc., etc. Unfortunately, that party is over. And so when the cost of money goes up, we think long duration assets will face a headwind. So here are our top 10 holdings. It's a slide we've shown often. I'd like to point out a few things. First of all, and comfortingly, the after-tax cash earnings yield, the underlying cash flow being generated by the businesses we own, on average, on a weighted average basis, is about 7.5%. So that's the cash they generate divided by what we've paid for those companies. And that is a very high number. And that tells you that we're not in, we've managed to avoid those super expensive tech stocks, and we're certainly not in any of the energy or resource stocks, which have really volatile earnings. Our net equity exposure is about 83%. Cash levels are approximately 13, and the put position is about 4 negative. So let's have a look at the portfolio. Why are we there? We've termed it. So healthcare makes up 23% of the portfolio. We like healthcare because it's economically insensitive, great business models, and generally toilet paper and toothpaste type businesses. 4 of the stocks make up most of that 23%. The first 2, Medibank and NRB, are both private health insurers, have done exceptionally well for us. Spoken about them before, and are really well positioned. It's really a purple patch for them. We've made a lot of money out of them. We have trimmed our holdings to keep them at a reasonable level, but still make up about just under 8% of the portfolio. CSL remains one of our biggest positions, ranking right up there with NAB and Telstra. Very well diversified geographically, and had quite a tough time during COVID, but is benefiting from the restart of both plasma collections and the recent acquisition they made with V4, and I'll talk about that in a little bit more in detail. ResMed, also the leading sleep apnea company globally, medical device business, and has had a lot of good luck in terms of its biggest competitor, Respironics, having to withdraw a lot of product. Now, the way we look at that business, so ResMed, what are we buying? About 40% of the business is made up of flow generators, 50% masks and accessories, and then 10% software services. We then ask, is it a good business? Well, it's a global oligopoly with its major competitors shut out. It's an economically insensitive business and strong demand driven by obesity. So we don't really have to try and guess the economic cycle. Very large scale barriers to entry. And we like the fact that it's a razor blade business model, because they sell the flow generators and they sell about 3 masks to every person who's got a flow generator every year at about an 80 to 90% gross margin. We think management has certainly under-promised and over-delivered for a long time now. And we think this is where it gets a bit sticky with the stock. It is our one growth stock. We think it's only a 5% after-tax cash earnings yield. We prefer 6%. And there's various reasons if anyone wants to explore that, why we still hold it. CSL similarly has changed a little bit with that acquisition of V4, but really is a very good business run by extremely competent management, and we think we can buy it at the right price. Moving on to the banks, we have about 15% exposure to banks, and these are mainly NAB and CBA. We think they're 3 best-of-class banking franchises in Australia. The first is the business banking franchise owned by National Australia Bank. Second is the residential home loans, particularly mortgages for CBA. And lastly, a global infrastructure asset management business. We have a small position in Macquarie Bank. Now, the core thing to think about in these businesses is that due to funding costs from deposits, which the funding costs aren't going up nearly as fast as interest rates are going up, and that's allowing the banks to widen their net interest margin. So the price they charge for their loans is going up faster than the cost of providing those loans in terms of funding. And we think there really are big barriers to entry for the big four. Also want to stress there's been a lot of talk about how tough banking is in the States. I'm not going to go through this in a lot of detail, but essentially what I'm trying to show you here is that most of the loans provided by Australian banks are variable rate and quite shorter dated. Secondly, really important to know that even if the banks can't get their money back from repossessing your house and selling it, they can still chase you to get the money back if you're the person who defaulted. Contradictorily, in the US, there's a fundamental difference. First of all, in the States, the consumers take out 30-year fixed rate loans, which they can break at any time at no cost to them. And the banks wear the risk of that. And secondly, homeowners in the States can throw back the keys, walk away without any recourse to them in a lot of cases, which means there's a fundamentally different risk to the US banks in a rising interest rate environment. I just wanted to point that out because banks in the States are really very different animals to those in Australia. Telstra, this has been consistently one of our biggest positions. It's done really well for us. Telstra owns and operates the #1 mobile network. We've read in the papers a lot about the problems being experienced by some of its competitors. This is an ongoing theme, and we think that this business, the mobile phone business in Australia, will continue to do very well. Secondly, we've been waiting for inflation. That's why we've been in Telstra. A big part of its earning streams is directly linked to CPI. So it's quite a good way to protect the value of the portfolio by holding a big position in this. Also, it's been overlooked in terms of valuation, and we think we've done well to hold it. So what are we buying? 65 cents in the dollar is a mobile business, 20 cents in the dollar is this recurring NBN income stream, and the rest is really rounding errors. We think the mobile businesses and NBN businesses are very good businesses. Management has certainly improved. We all remember the good old days where they couldn't seem to put a foot right. And certainly we can buy it at the right price. Another area where we've got stable, predictable toothpaste, literally toothpaste and toilet paper type businesses in Woolies and Amcor. So Amcor is a global packaging business. Woolies, I'm sure you all know. Both of them are good defensive businesses that benefit from higher prices because they can pass those through and they make a margin on their turnover that's fairly consistent. And therefore, as prices go up, they make more money. Just a quick snapshot on what we're buying when we buy Amcor. Flexible packaging at 85 cents in the dollar. Rigid packaging, 15 cents. So flexible packaging is all the medical packaging and food packaging. Rigid is really your Coke bottles. Really your Coke bottles and PET bottles. Really good businesses. They've consolidated their competence. They are now delivering environmentally friendly solutions to the big FMCG, fast-moving consumer goods companies. And we can certainly buy it at the right price. Now, a couple of other things, and then I'll finish up. Why are we there in terms of cash puts, and why effectively are we not there in energy? So first of all, the put options have given us good downside protection. They really keep us financially whole and psychologically whole. We've done this about 4 or 5 times in the history of the fund. I don't want to put too much on it. It's worked generally quite well for us. Recently, we had a timing issue and it didn't work that well. But since then, the put options have certainly added value. Rising cash levels. Now, we think cash is a low-risk income-producing option to take advantage of future opportunities. We've managed to negotiate higher rates for our cash, and we use term deposits, which are yielding quite good numbers, close to 4%. Importantly, we have increased our cash as a result of selling our illiquid, smaller cap holdings. And so we think liquidity crunch is coming. And so we want to be liquid for those rebased valuations. And we've got about 13% in cash. Now, the one area that has made us look not so good is the fact that we're not big in oil or energy stocks or even resource stocks. We have a small holding in resource stocks. Now, that has been consistent over the 15 years that we've run the fund. A couple of reasons. First of all, trying to predict energy prices or oil, particularly oil prices, is really hard. Should the hostilities in Eastern Europe cease, we think oil prices will come down quite rapidly, but they are quite volatile. Secondly, we don't have the benefit of finding the lowest cost producer like in BHP with iron ore. And so we're finding that it's quite difficult to get a position there. Energy stocks have been very, very strong of late. It's not our expertise. It's not an area that we will play in, and we're quite upfront about that. So if I had to wrap up just on this, we think the portfolio is extremely well positioned. It's very defensive. It has good protection against rising interest rates and inflation, very strong balance sheets and competent management. And so on that note, I might throw it open for questions. Adam, over to you.
Great. Thank you, Rhett. You did pretty well with the time as well. The first cab off the rank refers to performance, relative and absolute. Your fund has typically offered more downside protection during the tough times than we've seen in the recent drawdown. What's changed and what should we expect going forward?
Okay. So look, the first question is always the tough questions. That's absolutely correct. Typically, we have managed to protect capital more, and there's a couple of reasons for that, particularly on a relative basis. So first of all, energy and resource stocks have been extremely strong through this period. It's not an area we feel comfortable in. We have some exposure, but certainly, as I mentioned earlier, energy stocks have really held up the index. We have avoided the very expensive IT stocks. Those of you who've been with us for a while will have remembered our 100 club, with our 100 PE club. We've avoided those, and those have re-rated significantly. Secondly, I think there's been a wholesale sell-off. So there's been, other than energy stocks, there's been nowhere to hide, and there's been a general sell-off. Lastly, in hindsight, our cash levels, we were overly optimistic, given that we didn't want to be in zero interest rate earning instruments. We should have had more cash. Going forward, and the fourth reason was we had some illiquids that were hit particularly hard as everybody scrambled for the exits. We've sold a lot of those illiquids quite well. So we've reduced those. We've got higher cash, and we've got an after-tax cash earnings yield of 7.5%. And on that basis, I feel that we're very well protected against further drawdowns. Obviously, if the whole market sells off, we'll be affected. We are just over 80% affected because of our equity exposure, but we think that the defensive nature of the portfolio will hold up extremely well.
Were you not protected by your preference for quality stocks through the recent drawdown?
Yeah, so there was a bifurcation. So our Telstra's, our healthcare stocks, our health insurers held up pretty well, and those protected us. Unfortunately, I think our smaller diversified financials were impacted, and we've corrected that.
So what do you think is required for the fund to consistently achieve its cash plus 6 objective, especially sort of considering that cash is now a lot higher, 2.6%?
Yeah. So we think there's a combination of things. First of all, if the after-tax cash earnings yield, underlying after-tax cash earnings yield of the portfolio is 7.5%, that means that as you move through time, the shares or the companies will accrete about 7.5% per annum. Over and above that, we think there's approximately about 5% of surplus balance sheets across the portfolio, which we think will be released as we exit this volatile period and companies trying to manage supply chains, particularly coming out of COVID. So the 7.5% plus the 5% puts us in a really good place to achieve our after-tax cash earning, our risk-free rate plus 6%. And then thirdly, we think that the underlying nature of the companies, most fund managers think their stocks are cheap, but we think that certainly a large group of our companies are trading at just too cheap multiples. So we have a James Hardie, we have an Amcor, we have still the health insurers, we have a Telstra, et cetera, et cetera. We think the combination of the underlying after-tax cash earnings yield of 7.5%, the surplus balance sheets, and then a re-rating of several of our stocks will certainly achieve the desired return.
And that after-tax cash earnings yield of 7.5%, so two questions around that. How does that compare with the past in both absolute terms in your portfolio and relative terms relative to the market as a whole? And what is the risk of earnings disappointing and the yield coming off because of earnings disappointments?
So I'll answer the first two questions on a macro view, and then I'll go to the last one on an individual basis because there's 25 stocks in the portfolio. So first of all, 7.5% is at the high end. It has been at this level for a while, and it is definitely at the high end. So when I say for a while, for about 8 months now, it's been at these levels. So that's in an absolute sense. On a relative basis, if we go back to 10 years ago when we started, this was the norm. Certainly, when we spoke about that 100 club in that period, after-tax cash earnings were very difficult to find. And so the market was generally a lot lower. But there was a lot of money chasing the growth stocks. So hopefully that gives the history. In terms of the room for disappointment, so bear in mind that we have a model on each of the companies that we cover. We are constantly reviewing that model and going through, particularly in these times because it's volatile. We have taken pessimistic views on outlooks for all our companies rather than optimistic. The process is that when we own something, we're pessimistic about the outlook to see if we still own it. Obviously, you can still get it wrong, but we think we're quite conservative. If you don't own something, then you're optimistic to see if it can ever get into the portfolio, and then you do the reverse of being pessimistic. So let's go through a couple of our bigger holdings. The health insurers as a group are extremely resilient, and we've been quite hard on the outlook for their earnings. In terms of the banks, likewise. In terms of Telstra, we are extremely diligent in working out what the underlying cash earnings are, and we meet with management, or all the management teams, on a regular basis and revise those. The area that we're scratching our heads on the moment is around consumer discretionary spending. It feels like this is a slow motion car crash as more and more consumers start feeling the impacts of inflation and higher interest rates on their mortgages and start to pull their heads in on spending. So the areas where there could be real don't want to use the word accidents, but unforeseen sharp slowdowns in consumer spending would affect discretionary retailers. So we have two in that area. We have super retail and we have Accent One, making up about 5% of the portfolio. And the way we think about those is we have already dropped their earnings by 20 to 30% going forward. And we're still coming up with an 8 or 9 times earnings multiple, which gives us quite a big room for disappointment and still creating value. Also importantly, super retail, for example, doesn't have any debt and has quite a bit of cash on its balance sheet. And so hopefully I'm giving you, by pulling out each one of them, some feeling about how we've measured each one of them and assessed the risk return.
Great, thank you. I'm going to switch tack a little bit to stock specific. Ramsay Health, how attractive is it following the failed takeover attempt and subsequent pullback?
Yeah. Right, so complicated one. We have owned it in the past. We did sell it at higher levels, and we are currently looking at it. Generally, in this environment, you have the health insurers, which pay money to Ramsay Healthcare as their major supplier. And so when times are good for one, generally they aren't good for the other. We think times are really good for the health insurers. One of the big moves they've made is to really break the nexus of the over-servicing, particularly in remediation work run by the hospitals. So they found a way of making finding a much more cost-effective and without stinting on medical care way of rehabilitating people. This was a massive area for the hospitals, and so a big chunk of work has disappeared. However, we feel confident that Ramsay Healthcare will be operating at max capacity once we're over the COVID-induced interruptions to operations, and we think the rest of the business could certainly validate the current share price. We're busy running our numbers, and we think it may be added to the portfolio, but there are a couple of more questions around the impact of remediation we still want to clear up.
Makes sense.
So in summary, it's in the zone, but we've got a bit more work to do.
Great. So next question, what would give you comfort from a macro perspective to start deploying some of the cash that you're sitting on? And related to that, is there anything that you're buying at the moment?
Yeah. So there's a lot of hot money floating around. The tree, I have this analogy in my head about when you have this level of volatility and this level of are interest rates going to continue going up, or are they going to, central banks going to relent, et cetera, et cetera. You get this kind of volatility. Is Putin going to withdraw? Is he going to stay? Is China or the US going to go to war over Taiwan or not? All these issues floating around shake the tree really hard. And when the tree gets shaken this hard, there's a distinct feeling that something should be falling out of the tree. In other words, players or in big institutions who aren't as well provisioned or aren't as well prepared for this kind of volatility as they should be. Now, we've seen a few. The Bitcoin disasters were one, but it's still questioning why more hasn't fallen out of the trees. So we're nervous about that, and I suppose a clean out, particularly maybe in terms of European banking. It feels like there's another shoe to drop. So that's one thing we're keeping in the background. Secondly, we're getting a lot of mixed signals. So once we get clarity on the outlook, we'll feel a lot happier. And when I say this, logic tells you that when interest rates go up as much as they have around the world, the consumer has to stop spending. Employment is holding that up really well. And so we think it's potentially a slow motion car crash, but we're keeping our powder dry until we've got clarity on how that plays out. Pokie machine revenues are still hitting new records in Australia, which means spending is still very high. So we would like the impact of lower spending to be actually felt by the companies, or clarity around why it's holding up into next year before we started deploying cash.
Great. Consumer discretionary, what are your thoughts of this on the sector, and any specific names that you feel strongly about?
So I think I've partly answered that already. There are some very good consumer discretionary companies around. Some of them we think have been overdone, and so we own two of them. We're looking at a third, which we've just started owning. So, but very, very gently. So we're not going to disclose that one. Other areas like big companies like Wesfarmers, we think is a great business, and we think will be quite resilient. It's just always been so expensive, and it's fallen quite a long way, and we think we'll wait a bit longer. Generally, I think I covered off that we're a little confused about the consumer. We think the consumer globally should have buckled by now. We understand it's full employment that's keeping the consumer going, and maybe built up savings, and maybe the opportunity to travel for the first time in 3 years. But we do believe that high interest rates are like gravity on consumer spending, and it must pull back. And so we're waiting to see that fully reflected in share prices.
Great, thank you. The non-Aussie dollar exposure leads well to the next question. The Aussie dollar has obviously been smashed recently. What, if anything, is the effect of this on your portfolio?
Yeah, so that's a very good point. So for a long time, we've had quite a high exposure to non-Aussie dollar earnings for about a year and a half. And what I mean by that is we hold significant stakes in companies that generate earnings which benefit from a weaker Aussie dollar, because if they either trade overseas or they sell their iron ore or gold for US dollar prices, you get much more in terms of profit. So we have a long list of non-Aussie dollar earners, which make up currently about 30% of the portfolio. And these would include things like CSL, ResMed, both of whose businesses are more than 95% offshore. Amcor, ditto. Aristocrat already mentioned. James Hardie is a new holding for us, likewise, etc. BHP, Evolution Mining. So for a long time, the Australian economy has used the currency as a shock absorber. And we've seen that in the high-end property market. We've seen that in investors coming in to buy stocks and to buy products. Australia is going through a trade surplus boom at the moment, particularly given the hostilities in Europe. So the biggest producers of wheat and energy have been taken out of the market. Australia is a massive exporter of LNG, a big exporter of coal, one of the larger now swing producers of wheat. And imagine having the trifecta, the triple whammy of super high wheat prices, bumper crops because of a third El Nino, and then a record low Aussie dollar. So every week that the Aussie dollar stays down at this level and our trade surplus stays up at this, terms of trade stay up at these levels, it throws tens, if not hundreds of millions of dollars into the coffers of our both profits of our companies, plus the fiscal surpluses. So the tax dollars are enormous. And that's why we feel quite comfortable with the Australian environment.
Great. And So basically, I think that you've made a lot of the points that you usually make when you talk about Australia being the lucky country. Is there anything else? I know that that's a theme you feel quite strongly about. Is there anything else you want to add to that?
Well, I may put the slide up, which I always carried around with me. I think I've won a lottery ticket to end up in this country, and the country really is the lucky country. So, I mean, if you look at those slides from left to right, unemployment rate is at really low levels. Now, some of that is because migration got turned off and foreign students got turned off during COVID, but certainly unfilled positions is still at record levels, and we see that continuing for some time. In terms of trade, and that's really, how good things are for Australia, things just get better and better for Australia. And then if you look at where our exports, what makes up the exports, two things really stand out for me. First of all, metal ore, is big, so that's iron ore is chunky, and I'm always surprised by how much coal we export. And the blue line, which is LNG, is really a new entrant into this environment, and that continues to go from strength to strength. So, there's a lot of uncertainty. There's a lot of concern about global future. When you look at these numbers, Australia probably has the best opportunity of a large range of countries to avoid a recession. Now, the US, global markets fall over. We typically tend to follow, but certainly we are well buttressed by these factors.
Great. Mining services, do you own anything in that space?
No, other than the two direct producers of BHP and Evolution Mining, no, we don't own any of those.
And just confirming for the person who asked the question, when RET doesn't own energy, that includes coal. So no coal exposure there either. RET, you referred to a liquidity crunch being on its way. Can you just expand a little bit on that, please?
So, I know I don't have a lot of time, so I'll try and keep it short. Essentially, QE and unwinding QE means taking liquidity out of the market. QE was putting liquidity into the market, particularly by forcing down the short end of the curve, buying bonds. They now are unwinding their balance sheets, so they're removing the central banks around the world are removing liquidity. Secondly, as the cost of money goes up, free money is no longer available, and that means that people will find it harder to borrow. Housing prices coming off, maybe 5 to 10%, means that people who bought in the last 2 years are kind of stuck, because if they try to refinance, they'll find that the terms are no longer available given the way housing prices have changed. We also think that investors' risk profiles have changed, certainly been burnt by the Bitcoin, which destroyed a lot of value. And most institutions and individuals are becoming more cautious. There used to be a saying we had, there is no alternative to equities, so TINA, because you couldn't get yield anywhere else. Now we think there are real alternatives. So TARA, you can buy term deposits at 4%. So we think the landscape for where people put their money has really changed, and their risk profiles. And so as that liquidity drains out of the system, we think people with riskier assets will have difficulty working out how to sell them. And that's really what we're referring to in terms of the liquidity crunch. Sorry, I could go on about it for ages, but I'll just keep it. I think I've mentioned all the main points.
Yeah, no, I think that's comprehensive, and we promised everyone a reasonably short webinar today. So in the interests of time, I think we're going to wind it up there. If we didn't respond to your question or a version of your question, because a lot of the questions were quite similar, we will respond to you directly. Thank you very much for joining us this morning, and great questions. So thanks to everyone who submitted them. Our next webinar in the series is on Thursday morning at 9 a.m. and it's with Peter Bourne from Harding Loevner. He is the co-manager of the Pengana International Equities Fund, as well as PRA, which is the listed version of that strategy. PRA has an income focus and pays a fully franked quarterly dividend. You can register for that webinar on our website, pengana.com. If you have any other questions, please get in touch with us. We'd love to hear from you, and thank you very much and enjoy your day.